Thank you so much for watching Morning Markets. We know that inflation has been our guide for central bank policy and thus what assets are going to do. In Canada, we got another read of inflation and we saw a surprising uptick. Now, for 5 straight months, we have seen a deceleration in the pace of price increases. We got a modest uptick on a headline basis to around 4.4%. So still a far cry from where the bank would like to see it. But keep in mind, less than a year ago, we were sitting at inflation at around 8%. Then there's how we can torture the data. We can strip out food, we can strip out energy, and the number looks a little bit more reasonable. However, many economists are talking about what this means for the Bank of Canada. Can they still be on pause when you do have even just a modest uptick in headline inflation? CIBC suggested that, and we also heard from a Manulife economist who said something similar. Take a listen.
So really making sure that consumers, businesses, and the economy as a whole understands that the bias for interest rates is still to the upside, despite, I think, what many have interpreted as somewhat of an implied pause for both the Bank of Canada as well as the Fed.
And if you take a look at the Canadian dollar, it also rallied, implying sort of this hawkish interpretation that maybe the BoC, if it has a bias, it would be to hiking rates. Keep in mind, the market is still pricing in rate cuts later this year. Let's unpack all of this with Ed Devlin. He's the founder of Devlin Capital, as well as a senior fellow at the Howe Institute and former head of Canadian portfolio management at PIMCO. Thanks so much for being with us.
Oh, thanks for having me, Amber.
So what is your read on what's happening with inflation and how this will affect the BoC's decision making?
So I don't think today really moved the needle much. So everyone talks about headline, going from 8 to 4, how tremendous is that? But we all kind of knew it when oil was moving up. If it didn't go to $200, it had to do this. It's kind of the base effects. So to me, the central banks really focus on core. I mean, I think headline's important because, as you said, people can't strip out food and energy from their day-to-day lives. So I think how that manifests itself is in inflation expectations. And what the central bank really focuses on is inflation expectations, keeping them well anchored, don't want them to get out of control. That's what really got us in trouble in the 70s, et cetera. And we also want to watch core inflation, which is the best predictor of kind of the steady state inflation. And if you actually look at core inflation, it kind of peaked around, call it 5.5, and it's now at kind of 4.5, a long way from 2. So it has improved. So the trend is really good. It peaked and now it's on its way down. But I do think we have a lot of wood to chop. And I think people who are talking about changes in policy imminently are probably jumping the gun because it is a 12 to 18 month lag between changing rates and then feeling the effect.
How do we think about how the Bank of Canada might actually be stoking inflation because one of the biggest cost increases that Canadians are facing is their mortgage expense, and that surged here as well. So they're raising rates to cool inflation and then simultaneously at least causing one part of it to go up. How does the Bank of Canada deal with that?
So I think, it's technically inflation, but reality is it slows the economy because you have to spend more on your rent or your mortgage, and you have less for everything else. So it's one of these things, I think, when you're looking on a forward-looking, you kind of look basically through it. It's a factor, but you kind of look through it because it's not helping grow the economy, as opposed to saying rates are too low and inflation's taking off. When you have inflation up because you've got rates up, that's probably going to bring down the growth in the economy.
Probably, but is it, right? Because we've been waiting for it. We don't see it really showing up in a meaningful way in the jobs picture. There's other factors. There's immigration that could mean it never shows up. How do you think about that?
So that's terrific. I love that. I love what you just said. Because if you think about, I remember everyone was saying, oh, housing prices are going to collapse. Well, did you not realize how much immigration we're bringing in?
Yeah.
So, to me, everything doesn't look quite stable yet. And we've come out of this pandemic. So there's mixed signals right now, I would say. Like today's report, I like that service inflation came down. Because you think about it, right now we had, restaurants and all these services are starting to staff up from nothing and had to pay up to get people. So to see that coming over a little bit, basically the way I would look at it is the trend has not been set. It has been set in the sense of we peaked and we are kind of slowing. But are we in a stagflationary world? I don't know. Think about the balkanization of trade, what's going on with China, et cetera. So to me, it's not clear. It's also not clear given, the lags in monetary policy. So to me, I would think that in the next few decisions for the Bank of Canada, I find it highly improbable they'll change policy. The Fed's just gone on pause.
Meaning they stay on pause.
But they just keep where they are. You know what? The trend's not there yet. There's no reason to be head faked. Kind of just let's watch it and see if the trends, reverse themselves, because there's always noise in the data. And to me, that headline missed on the upside today is noise.
And I'm glad you point that out, because I do want to look at that long-term trend. And the bank itself has admitted that it's going to be easy to get to 3%, I believe. The challenge is from 3 to 2. And I think you said this before, never has so much been riding on on a 1% move. I mean, if you look at this mathematically and extend the run rate, we are going to see inflation, are we not, by the end of the year, back down to target, if we keep this trend going?
I'm not sure about that. So I would say, kind of mathematically, headline getting down in the 2s because of the base effects with energy specifically. Probably likely to see, but then you'll see it bounce back again. So the real one to keep your eye on is the core.
Okay.
And so it's just moved, it's moved up significantly, 3 or 4%, and now it's moved down 1. It's a few percent away. Let's see what the pace of that is over the next coming months.
I want to underline that thought that we might get to 2%. That doesn't change the Bank of Canada's thinking, and that's not what the market is pricing in. We think we get to 2, we've hit the lottery, we can cut rates.
Yeah, I mean, what they want to see is around to really between 1 and 3.
Yes,
that's kind of their tolerance rate, and and headlines their objective, but core is their guide.
Yeah.
So and their models would kind of say, if you keep observing core, headline will kind of move around it, and that's kind of where you want to be.
I guess I'm trying to get out from you, should we be betting on rate cuts? It sounds like, based on your analysis, that's not what the BoC is going to do.
Well, right now, if you actually look at the market, there's like a 20, 30, probably a little more with the move this morning, percent that you're going to have a 25 basis point hike in the next couple of meetings, even as early as the next meeting. I think that's wrong. I don't think that's right. Then you got rate cuts priced in near the end of the year, and we'll see. I think there's always noise in markets. There's market positioning goes on. There's enough uncertainty that I think there's going to be a great opportunity for investors. I think right now there's a little confusion. My guess is there'll be a lot of confusion later, and that'll be the time to really kind of position your portfolios.
What are you doing in your portfolio? What's your best recommendation right now, given all of this?
Actually, the best recommendation is not in Canada, funny enough. You see here today, you see how volatile the markets are?
Yeah.
Well, the best options market in the world is the U.S. mortgage market, what they call Fannie Mae and Freddie Mac.
Yeah. If
the spread between those and treasuries is wider today than it was in 2008.
And you don't think that's reasonable? I
think that, and what that is I would think that they'll come down over time, and I think that's probably the cheapest credit security I can see in the G7.